we're gonna have pain the last of most anybody else in the Western world, right? But there's gonna come a point where the central banks are like, we need to do this. Inflation is going to become permanent if we don't destroy demand. But at a certain point, the people just start rising up and voting in politicians who will give them stuff. But I do, to your point, Eric, think it's worth differentiating between us going back to an era of like zero interest rates versus like us going into an era of like infinite like fiscal stimulus.
Steven, let me see those shoulders. Let me see some shoulders.
One time you sang for us. Can you dance for us this time?
I sang for you?
Yeah, you sang the Top Gun theme song one time at the beginning of an episode.
Oh, that's not really singing. That's pretending to be a synthesizer or an electric guitar. I forget which of the themes I
You're
sang.
flexing your musician muscle.
Wow.
What a flex. Such a musician.
How many drinks deep was I?
Beethoven's Godchild.
It must have been a third episode.
That's definitely a third episode. This episode's only a 0.5 drinks episode.
So before we get to the alfalfa round, maybe just I'm curious. You posted a podcast, hyperfinancialization, doomy, gloomy, seems like episode in the Discord in the Money Channel today. I don't have time for podcasts other than my own, so I was wondering if you could give me the TLDR.
Just like before we get started, you want to
I just want
TLDR
to lubricate me, you know?
Yeah, who's that? That was by Julian Brigden. Julian MI2, I think, on Twitter. Yeah, that's a great pod. It was on I think it was on Forward Guidance with or maybe the other, I don't know. There's so many Blockworks pods I listen to, I lose track. But yeah, I mean, the general gist of hyperfinancialization is just that like we transition to this economy where we just sort of like export dollars and manipulate interest rates for decades, and it's like warped a lot of stuff in the economy. It's produced like asset bubbles that shouldn't have existed. It's produced companies that shouldn't exist, and we're sort of just unwinding that right now, just sucking all the air back out of the balloon, and it's manifesting in like a million different ways that we're going to feel. But the world we're used to is not like real life, basically. Yeah. Like Uber is a good example of this. Like us taking a $3.80 Uber to Little Italy, that was not real life. That was Uber subsidizing it because they had free money, right? They just, well, we can borrow money for nothing. Let's dump all of our money into user acquisition by just subsidizing free rides.
And then Lyft would show up next week and offer.
And then Lyft did it.
$5 extra
Postmates
off
was cheap,
Yeah.
and DoorDash was cheap. And like so many of the things you use were just like free because of subsidized user growth.
Not going to lie, I miss those days.
I mean, it gets worse though, because it goes into all the products we buy. It goes into like so many, like so many different things. And that's not coming back, maybe ever, like the days of like China just making infinite cheap crap for us, and us just blowing up crazy NFT bubbles on zero interest rates and infinite
do you
QE
do you actually believe that it's not coming back ever? Because I also, on the other hand, I believe that we're kind of, the pendulum's swinging the other way. But don't you also believe that on this like fiat debt-based system, there is only one path forward, which is to keep the Ponzi going?
I think that we are going to enter a really interesting time at some point where the central banks start butting heads with the government, which isn't nothing new. I mean, it happened to Volcker in the 80s. He was getting death threats, and Reagan pulled him aside, being like, don't raise interest rates, don't do it. But we're already seeing this, and you're seeing it in England. Obviously, they already did like quote unquote temporary QE. It's nothing so temporary as a government program. Nothing. Oh, sorry, I butchered that quote. Nothing so permanent as a temporary. Sorry, Ronald Reagan. But I think we're going to see that here too pretty soon. I mean, we're going to have pain the last of most anybody else in the Western world, right? But there's going to come a point where the central banks are like, we need to do this. Inflation is going to become permanent if we don't destroy demand. But at a certain point, the people just start rising up and voting in politicians who will give them stuff. But I do, to your point, Eric, think it's worth differentiating between us going back to an era of like zero interest rates versus like us going into an era of like infinite like fiscal stimulus, like we could have just persistently high interest rates, persistently high inflation, and persistently high like stimmy checks from the government raining down on us from every corner for a long time.
Oh
And
boy.
yeah, it's gonna be a fun decade. It's gonna be well, I mean, but by fun I mean probably not fun.
Yeah, I want to get to some of that because I have some more questions on this. But it's good to see you guys again. Holy shit. I didn't like last week. I'm not going to lie.
Well, I thought last week's episodes were amazing.
They were great.
But yeah, I haven't seen you guys in person around this table in a long time.
Yeah, I like this. I'd like to keep it this way.
Yeah.
All right, Alfalfa round. Garrick, why don't you?
Okay, so my Alfalfa, like this is kind of like building upon what Steven's saying. It's like, we have this whole ecosystem of assets that are falling, right? But there's still things that we need, like utilities and energy is something that we need. And a week ago or 2 weeks ago, I was in the money channel of our Discord talking with you guys, and I'm like, I just said, I want to buy oil. I want to go long oil, and I didn't really know how to do it, right? Like I didn't know the best vehicle to use. So I went into the XLE, which is just like Vanguard Energy ETF, and that is up 15% over the last 5 days. So I closed that out. I closed that out today, just thinking like, I actually believe in this thesis long term, but anything goes up 15% in 5 days in this environment, I want to just realize that gain and get the fuck out and just stay in cash mostly. So that was like my big trade. That was like my only one move.
Nice. Making moves. What you got, Mr. Moves?
Yeah, I mean, I'm actually not making any moves right now.
Wow.
Yeah, I mean, I meant
Joins my club.
I meant to go long a couple of days ago because I was very on board this idea that we were going to have a little rally into October to start Q1, and so far that's proven like very correct. But I kept getting greedy with my entries and didn't get into anything. So my next stop at this point is probably to just back up the shorts truck. Got my eye on a couple coins. I'd really love to short Cardano to hell. It just looks like the Bitcoin chart from 2018 with the little triangle and that support that just seems to me like it's very obvious it's going to collapse at some point.
Man, I want to have an episode maybe of one day of just like the short basket. Like what's the thing?
Oh, that's a good idea.
That'd be great.
That's a good idea.
Because I think Cardano belongs in there. I have some other ones that I've been riding and then getting out of and then riding again. And I think that'd be a fun conversation.
I really want to short.
Or is it just people dislike it so much?
No, it belongs in there. I think it looks the chart looks terrible.
Well, it has all the characteristics of things that you'd want to short, which is like high beta and no fundamental value.
Negative fundamental value.
I mean, did I talk to you guys about I watched an interview with Greg Jensen from Bridgewater a few weeks back.
We have not talked about this.
Oh, yeah. I mean, he said something that I thought was really interesting and it applied to both the real world and crypto investing. And he was just saying that basically there's like sort of two types of assets now. There's assets that are able to generate their own sort of internal cash flows such that the price is able to be stabilized by some particular floor or some particular sort of like internal driver. Obvious example of this would be like a very like old sort of dividend paying stock that's just chugging around and sort of recession proof. And he said the other type of asset is just pure liquidity assets, like assets that don't generate any sort of internal. Okay. And those assets in particular are sort of conditional on like flows coming in perpetually to support the price or keep the price from going up. And I think what he said is basically like 99.9% of crypto, for the most part, but not ETH. And I think there's probably a couple other coins you could maybe argue. Like everybody likes to talk about GMX, for example, which is the sort of DYDX competitor, Perp Exchange on Arbitrum, and I think they're on AVAX too, which generates like a tremendous amount in fees, and so those fees go to the token, and it's actually been one of the best performing coins in the bear market because of that. Yeah, my problem with it is I don't know, just the design of it makes me a little nervous. Not to FUD, but like it's a giant honeypot, and people have tried to attack it, but I don't know, it might be fine. But I think in this type of market, right, like everything in crypto, God, like a Gigantic Rebirth, like the famous like super epic Chad trader who shorted Luna and then closed out his $25 million trade for like $2 or something to hedge back in the spring. I remember he made a post like in last November, I think, or December, and he's like, here is like the inflation in crypto in aggregate. Like this is the raw amount of coins that are just pumped out into the market every day. And these are the coins with like the highest like inflation schedules. He's like, I'm going to short the hell out of these things because as soon as the music stops, there's not only is there no supportive flows, but there's active like sell pressure, relentless. And like that trade played out so well for him. But that's still something we have right now. And like the obvious kind of thing we look at is Bitcoin and Ethereum. And Bitcoin, hate me for saying it, like doesn't have any internal flows that support price. It's just purely speculative. It's purely based on people kind of coming in and buying into the dream and supporting the price. But Ethereum does have this sort of built-in supportive flow, driven by internal demand for the token to do stuff. And it creates, even the other day, we had a couple of deflationary days in the middle of a bear market, right? So I do think we're gonna start seeing this separation at some point. Maybe not yet, but like that. I thought what he said what Greg said was like, I was like, it was kind of like an aha moment for me. I'm like, yeah, you don't want to own anything right now that is just purely dependent on liquidity.
Oh yeah, I feel like Buffett is gonna kill it if he's alive in 10 years. He's gonna have a great decade because this is gonna be like his like value plays finally getting their time in the sun. These are like cash cows. All of his businesses are just spitting off cash.
It's gonna be. I've heard a lot of people say that the next 5-10 years it's going to once again be like a stock pickers environment. Like, oh my God, like who would have thought it? But like you actually have to select companies on the basis of like who's doing things well and who's doing things poorly, as opposed to just buying the index and everything goes up and we've got zombie companies left and right. Like, it wasn't always like that. There were decades where like being a stock picker was like a thing that was value add and like people did well, and it's been like useless basically for the last decade. But I think tides are going to turn now.
Pretty easy. Like I think the opportunity is pretty clear for me, which is like pair trade it. Pair trade it, meaning like you maintain a neutral exposure overall, but you're long stuff that has cash flows supporting it, and then you're short these just purely speculative
and
assets.
what would be neutral?
Neutral is like your long and short equal amount. So your dollars are neutral, but like the ones that are short are going to go way down. Even if the whole market's going down, like your short exposure is going to protect your longs.
Yeah, I like that. I mean, there's a bunch of spread trades I've been looking at in crypto. I haven't put a lot of them on yet, but I think there's like interesting plays. Like you can, and I'm not sure I'm going to do this one, but coin like a Curve or Convex, right, versus ETH. Those are just sort of infinity inflationary coins paired with a coin that is not inflationary, So you're sort of like not directionally betting on crypto going up or down. You're just betting on things diverging within crypto. And I do believe things are going to diverge very heavily within crypto at some point. It's just been a bad environment to spread trade ETH because of the overwhelming sell pressure of people just like unwinding the merge trade has just way overshadowed any of this stuff, right? If you thought that the BTC ETH trade was going to like play out after the merge, you got absolutely dominated because like your time horizon is too long, and in the 24 hours post merge, like all that sell pressure sort of just wrecked you. But that's going to subside, and then I think it could be interesting next year crypto. I think there is an opportunity to do these sort of pair things and probably make a lot, honestly, like because there is a big discrepancy between like stuff in crypto that is good quality project and stuff that is kind of just like almost programmed in a way to go to zero. So that's what I'm going to be looking at probably in Q4 to put some of that stuff on. But I definitely want to see how stuff shakes out in the short run a little bit.
All right, let's. That was great. Let's pivot. Well, wait a second. We were in the middle of a fucking alfalfa round. What happened there? You guys get in a flow state.
We're just vibing.
So Nick sent me his alfalfa.
Oh, you did?
Yeah.
Nice.
I'm gonna read it for you guys.
Can you do it in his voice?
Hey guys, drinking a rosé.
So guys,
Hope you're doing well.
Rosé in France.
I see your text, but can't be bothered. I am having way too much fun.
Good.
I actually threw my phone in the ocean. iPhones are for losers. Money, got all I need. Staying out here. Podcast, I'll remote in when you need me. And see you guys later.
He's gone forever.
Oh, yeah. He's in the south of France.
Starting to think Nick didn't actually.
Did I say that part? He is in the south of France. Yeah. Love you guys. Bye. We miss you, Nick. That is not a real alfalfa round from Nick.
You just made that up.
I completely made that up because I'm assuming that's exactly what's happening. I think he's having the time of his life right now.
I can confirm that France is some good alfalfa.
I saw some Instagram story posts from the GF, and yeah, they're doing it right. He's having a grand old time out there. We miss you, Nick. I'm assuming you didn't make any trades. If you did, we'll have to catch up on that next week. So my alfalfa, haven't made any crypto or financial moves at all lately, but I do have one sort of realization that I've had. It's sort of like a psychology / culture alfalfa. More, I would almost call it a perspective alfalfa. Now, I mentioned this very lightly in the Iran episode, which I'm really glad we did because a lot of people have reached out to me personally, just saying like, what a just revealing episode that was, and what a great job we did, kind of distilling this really difficult thing. And one of the things I mentioned in that episode was how this idea of people on social media posting or doing things to support a movement. Did you see that? Posting or doing things to support a movement. Like I have watched in the past without even realizing it and judged people's behavior on social media, assuming that it was virtue signaling. And what I have gotten completely wrong is that the actions that people take online are extremely significant and important. And I had always just chalked it up to, you're doing this to feel good about yourself, you're doing this to virtue signal, or you're doing this to be part of a group, an idea, an ideology, to express groupthink, to simply just cast a vote and say, I'm with them. And that doesn't mean that there aren't some people that do it for that reason. But what I have learned as a result of being more involved and more emotionally entangled in this Iran situation is that that is not only false, but extremely beneficial for people to do. It makes a massive difference, especially in a situation like Iran, where we can't send them money, we can't send them weapons, we can't do anything. We can't go in there and help them, beat censorship and be able to access the internet and VPNs and safe browsing to be able to share the content. We can't do any of that. What we can do is actually spread the information and the content itself that does get out. And so these things like posting the flag of a country or, doing, I don't know, there was like a thing I remember that was happening last year in, I think it came out of Turkey and it had something to do with women's rights again. I don't know if you remember, but they were posting like black and white images of themselves. And I don't exactly remember, but I remember people just being like, this is stupid, don't do this, you're just following the crowd. But actually what I got wrong is that was helping that message get out into the world. And I was just completely wrong. And that was a big perspective shift for me.
I agree with you, but I also agree with like your first take, where it's like you have this inherent bias where you're thinking like, this is kind of stupid. I had a similar breakthrough when I was watching a Padres game, like a baseball game, and they were singing the national anthem and they brought out a big American flag in the middle of the field before the game. And I was like, in this moment, I was like, why the hell are we doing this? It's a baseball game. But then it struck me. It's like, everything's a meme. Like everything in life is a meme, and it's all about just like spreading and continuing the meme. And it's like, I think it applies to Iran. It applies to everything that you're talking about. It applies to everything that we really know in modern society.
Yeah, and baseball. There's nothing more American than baseball. Like,
Well,
I
that's
mean,
the meme. Like
yeah,
they
exactly.
built that. They built that meme.
And if it loses that, then it loses the whole
Right.
culture of baseball as a whole. So yeah, good for them.
Yeah.
Cool. So the purpose of this kind of episode and what you really personally wanted to get into, Stephen, was kind of a Q4 preview of things to come. You were mentioning Q3 was crazy, it was chaotic, and we had some dreams for what Q4 would be. How does that look now?
So Q3 was sort of like we all thought we were going to die. And then we thought, oh, wait, the pivots come in. We're going to have a little Goldilocks. We're going to back off interest rates, but then growth will sort of remain pretty strong. And then we'll get this like inflation down, growth up. And yay, we're all going to make a bunch of money. Combine that with the merge, combine that with elections. It seemed like a really nice cocktail to, at a minimum, ride like a really decent bear market hopium rally. But yeah, it turned out the rally was hopium because I think the turning point was when the core numbers came in September, and they were like higher than people thought. And then it gave a lot of merit to this idea that like inflation wasn't going to be this thing that sort of peaked and then just went down. It was going to be this kind of like sticky thing that kind of swung like up and down and like back and forth, almost like a sine wave up and down. It's going to go up and then down, and that like scared the market. And then Jerome and the Fed came out and just sort of reiterated the Jackson Hole message. It will be enough. I think he said at one point, like, we will get inflated, we'll do what it takes, and it will be enough, kind of echoing what Mario Draghi said during the last crisis in Europe. And the market was sort of like, message received. We priced in like higher cuts and more importantly for longer.
Oh, we are dead.
Hikes.
Oh yeah, we're dead. Okay, yeah.
And then it all went to hell. ETH went from 2K to 12 something. The market retested lows. But now we're at a new quarter, and I think it's appropriate to sort of like think about what could happen and how that will affect like our game plans. Like I guess I could just throw out my view on what I'm sort of seeing and how I'm planning for it. I guess I won't go into like a bajillion details, but like I think that we're going to see lower on the S&P for a variety of reasons.
You're talking about in Q4.
Almost certainly in Q4, but at very least in Q1 of next year. I think Q4 is interesting because in the US, I do think like corporations and consumers are a lot stronger than people may think. Like earnings I think are going to probably still be pretty strong. Corporate balance sheets are still, like, savings is enormous. Like household savings is at like the highest level since like the 50s, I think. I mean, like it's like kind of crazy how much money people have stashed away. And if inflation does like taper off, like what happens is you have this effect where you get inflation, right? And like people's wages rise and the cost of like everything goes up. But if inflation dips down and the cost of goods dip down, then you end up with consumers with these wages, which are sort of sticky. They have like real purchasing power, and in real terms, like they're stronger, and like demand can actually remain like very high, and like corporations are able to sort of maintain like greater pricing power, right? Because if the GDP is sort of going up in excess of their employment costs, and that means better earnings, like better margins, right? So in the U.S., like things do look kind of rosy in the near term. What like I worry about is the QT, the quantitative tightening. That like net liquidity, we've talked about it a bunch. That has continued to just fall off, and we're at a point now where I think the market might be playing catch up. But overall, looking forward, like a lot of people I respect and look up to, and read their stuff, and who I think are a lot smarter than me. I haven't seen anybody call for anything above like 3,400 S&P, and I've seen 2,800 S&P. And these numbers make sense to me in terms of like resetting the system to where it was like before we just like injected all of this liquidity into it, at least like pre-COVID, right? And I just don't see a world where stonks go down and like everything else just doesn't kind of peter down with it. And in my mind, like the trade right now is just sort of like it. Like I think short crypto is a great trade because like crypto is just the essence of the everything bubble. I mean, I would short Bored Apes if I could, but I can't. So like I have to short.
You can short ApeCoin.
I mean, I might. I might. Like I should ApeCoin be worth $1.6 billion? Like no.
If we
apply that to everything.
If we get to our short basket episode, ApeCoin is something that's on my short list for the short basket.
Yeah, but like I'm of the mindset that we're gonna bounce here. Probably we might not. I mean, I already have some hedges on in case we don't. But like I'm just sort of planning on heavily selling any rallies, and that's
so this
that's
is
where I'm
interesting.
looking.
I think what you're saying is all I agree with, and I think it's consensus actually now. I think a lot of people have gotten onto this idea that like, we're not going to see a Fed pivot anytime soon. We're going to see continued downtrend in S&P and risk assets. I don't think that 3,800 S&P is probably a fair value right now. I think it's probably much lower. A lot of people see that now, but I think when you get so many folks offside to the short side, you can see a bump higher, and these things don't go in straight lines typically. So like right before the end of the quarter, like we talked on the last episode, I closed all my shorts out, and I'm not jumping back in long, but I do see a situation where it's just like a repositioning of like market participants who have like gotten so bearish where it's like, well, maybe you see some kind of pop here, and that would be to Steven's point, like that'd be like a short entry at that point. But like I don't really want to go long here. But I think in a near term, like in a Q4 scenario, like midterms coming up, like this was always the thesis. They are going to pump liquidity into the midterms, and I think like we're going to see that in many cases, like not just the Fed net liquidity measure, but we're going to see it in like the SPR. We're going to see it in like oil reserves. We're going to see like them trying to pump whatever they can over the next month or two. I believe, and that's why I closed the shorts out. And S&P's up 5% over first couple of days of the month. This has not happened very often. Like this has only happened like 14 times since 1960, and the 6 months after this has ever happened, it's like in 12 of the 14 examples where the S&P's up 5% over 2 days, the market's ripped. But the two times it didn't. The two times it didn't were in 2008 and 2000.
Ooh, okay.
Yeah.
So
I was waiting for the go ahead to dunk on those stats.
yeah. But what I'm saying is these things don't just go in straight lines, and I think we all agree on that. And like I would be reluctant to just be like levered short right now. Even if your sort of medium term view is S&P 2800, like it doesn't have to go there today, tomorrow.
So short term, you guys see some rosiness potentially, but by early next year, Q1,
Probably not even.
perhaps
If I
sooner.
were a betting man, which I am, a frequently wrong betting man, but betting nonetheless. Yeah, I mean, there's a strong confluence of stuff to be bullish in the short term, right? You had the S&P sort of trade down below the lows and then recover it pretty quickly. That's usually pretty bullish when you lose a big level and then like go right above. You tend to trap a lot of people who are short. Those people who are short start panicking. They cover their shorts. That's like fuel to kind of push the market up, right? So you have that happening. You've got Bitcoin just trading at infinite. Bitcoin is just like a 19K stable coin
20K forever.
now.
Yeah.
That's just what it is.
The most stable asset in the world.
Ethereum was consolidating kind of nicely above that, 1K to 1200 range after selling off quite a bit. Even a lot of altcoins, they like look like they've quote unquote bottomed. Plus the dollar, right, had a huge run up and then like kind of hit the top of its long-term channel and just absolutely tanked while Bond yields absolutely fell off a cliff as well. All of these things in aggregate are bullish for risk. And I think if you're fading them right now, it's a little bit suicidal. It's not to say like we can't wake up tomorrow and it's a bloodbath and all the bears will be like, you idiots, but like realistically speaking, the deck was stacked and probably still is stacked for a short-term rally. It's just, it's always hard too when it happens. You're even if you plan ahead of time, you're like, oh, this is it. This is different this time.
I almost feel like the fact that you've capitulated now to be like super bearish is like, now we'll see the rally.
It would be appropriate.
A month ago, you're like, no, we're going to see 3K ETH.
I mean, I wasn't wrong. I just,
yeah, you might be early.
I just didn't take those profits, but such is life. I'm curious, like, do you have like a target you're looking at, or are you're more of like a timing thing? ETH or S&P? Like, where are you looking to get short again?
So with ETH, like I just entered today. I sold ETH calls out of the money ETH calls. So at 1750, I'm just happy to sell ETH.
What date?
That's end of October. And the idea behind that is like some ETH just got put to me. Like using FTX derivatives, I settle in physical. So like some ETH got put to me, and I'm happy to exit at 1750 end of October, which like I don't think is going to happen. I think I'm going to just collect the premium on those anyways. But, if it does, so be it.
Armand.
Yes, sir. I'm waiting to jump in. May I ask a question?
I would love for you to ask a question.
It was a pivot, though, so I didn't want to take away from that. One thing that's been on my mind, and I haven't been able to catch up on it, is, there was a lot of talk about Drunken Miller and his little talk, and I was trying to find the video, but there was only that transcript of it. I went through it, but basically what I took out of it, I wanted to get your thoughts on. I mean, that was one of the most sobering, bearish things I've come across in a long time, and he's the most prolific and accurate sort of macro guy to date.
He's a goat.
Right?
He's a
goat. So he's a goat, very goaty. And he's talking about this thing, like he's comparing this to eras where we've had decade-long recessions. So how are you guys working that into everything that you're seeing right now? Is that kind of like in a compartment for you? Did you just take that talk and sort of put it in the back of your mind and compartmentalize it? Or have you worked it into some of what you're thinking about when it comes to just short-term to medium-term time horizon that we're discussing right now?
So Druck's been touting this same narrative for a long time, actually. That's not new for him. He even 18 months ago, he was like, this
sure, it's just like we're getting an updated version.
Yeah. That was he
was ringing the fire alarm. Like I remember just maybe a week or two before the 2021 Bitcoin crash, like in the spring.
He's like, this is an everything bubble. It's all going to end in fire. And he was right. He's often right, like you said. I'll just go first. Like one thing that he said that stood out to me is that, I'm start bullish actually. One thing he said that stood out to me is like, if we just assume 3.8% interest rates on our national debt, then our interest payments are going to exceed all of our healthcare payments by 2027. So it's an unsustainable level. On that front, we can't just have like our interest payments go so freaking high for forever, right? So there will have to be a Fed pivot eventually. That's bullish for me eventually. So I'm personally not a subscriber of this like 10-year death. It might be a death of many things. Like Stephen pointed out, we have zombie corporations, we have shit coins that are ever inflationary, et cetera, and we might see a lot of death. But like I'd happily pair trade that with things that are good.
I remember you pointing out though, you were like, it took us just even in our lifetime. I mean, in the 2000s, it was post.com, right? It took us like 10 years to get back to previous levels
for
right?
the NASDAQ index to recapture previous highs. Yeah. And that could be the same thing, but you get a lot of froth within that. but there are still companies out there that are trading at very favorable like price to free cash flow ratios
Is that why it starts to become a stock picker's sort of dream territory?
Kind of. I feel like this is going to be Warren Buffett's decade again.
Yeah.
Like he's just going to back
to his
always
fundamentals.
on the fundamentals, and I think people lost the fundamentals. And,
Sure.
And like even when like in 2018, 19, I was like thinking like, oh my God, this is so frothy. But then I got caught in the trap. I'm like, if I'm not buying this stuff for clients, then I'm getting left behind. And it becomes like this cycle where everybody kind of falls off the cliff. All the lemmings just like follow each other right off the cliff.
I mean, because it was 10 plus years where his formula just wasn't as successful as
it just didn't work.
Following tech growth stocks and just everything that had absolutely no fundamental.
Yeah. Well, the trade was just following liquidity.
Yeah.
It was just long duration stuff. That stuff just got pumped like crazy. I think the drug question is really interesting, but I think that something that's like often overlooked is like the path it takes you to get there, right? Like if I told you that we're going to be break even from today, 10 years from now, but I told you that the way we're going to get there is next month, there's going to be this insane black swan event. ETH is going to go to like $40 and then it's going to recover to, $1,400 in 10 years. That's not terrible for you as an investor. The horrible path for you as an investor is like, I tell you, ETH's going to be $1,400 in 10 years, but it's going to be $2,400 next year. Then it's going to go to $400 the next year. Then it's going to go to $1,700. And then it's just going to violently, go up and down basically with no gain, no real trends for you to even follow. Like that's like the nightmare scenario.
But there's a nightmare scenario for somebody who bought into, cost basis of ETH at 2,500, 3,000, watching it right now at 1,400, goes down to 40. They don't do anything about it. They hold and they wait 10 years. So really they had to wait 14 years to get to break even. And they still haven't made it.
But I would argue that like if Jerome does what he wants to do, which is to just totally nuke everything and fully empty the balloon, I don't think the Druck thing happens in terms of like a decade of violently sideways volatility. I think the trap is if we don't really get to the point where inflation does subside, we get like some mega like economic collapse, the central banks get pressure, we turn back on the money printer, none of the structural inflation issues are resolved. So as soon as the economy picks back up again, inflation rears its ugly head again. And then we have to kind of keep doing this like on and off dance, which is just this violent back and forth while central banks are like fighting policymakers who are trying to dump money in. Like that's like kind of the nasty scenario, I think. I think it's better if we just eat pain for 12 months and then we can just kind of resume a normal economy.
I totally agree. But I have a question because we did an episode on inflation at this table. I don't remember what episode number this was, but at this table, you guys convinced me that inflation was a supply side issue and it wasn't just because of monetary policy. So my thought is supply side issues will normalize and, inflation will come down as supply side issues normalize. Like we came off of COVID and et cetera, like China's still at a zero COVID policy, which is kind of like hampering things. But like at some point, supply side is going to normalize and inflation will come down, and the Fed at the same time is squashing demand. So surely inflation will come down. And once it's down, then we can also normalize monetary policy, which is lower for longer.
I think what you're saying is partially true if you're talking about sort of temporary COVID demand shocks, right? But what you got to understand is like, there's a lot of stuff that's just structurally shifted in the world and isn't changing, right? Like demographic shifts aren't going to like reverse. The bringing of like the supply chain back from China into the West or into other areas is not going to reverse. Using 0% interest rates to sort of subsidize cheap manufacturing and all this currency manipulation BS to basically get cheap goods, that's not going to reverse. So I think a lot of this stuff, even though it is supply driven, I think a huge portion of it is just like sort of permanently structural in a way. And I mean, my big fear is that a lot of this stuff could be resolved through like sufficient, like, CapEx, where you are investing in stuff that's going to actually increase supply. Like oil would be a good example of this. Like if we had more investment in oil and carbon fuels and whatnot, like we wouldn't have this crisis right now. But we didn't. And what's like really discouraging for CapEx? High interest rates and declining demand. Like who wants to invest when people aren't buying stuff or demand's declining? Who wants to invest when there's regulatory headwinds? And then who wants to invest when the cost to like fund your project, the interest rate is like super high? And oh, by the way, I forgot another thing. Like there's less free capital just floating around in the system that wanted to just put it somewhere because like there's just liquidity everywhere. So it's like this quadruple whammy of stuff that's kind of like like a big headwind, I think, on the inflationary supply side of stuff that's going to be really rough to navigate from what I can see.
I think I'm still maybe too optimistic. I'm still optimistic. Like Raoul Paul is kind of a LARP, right? But he brought up something maybe 2 years ago that stuck with me. He said like inflation is kind of like ever present in that it's down on, like the technological forces will always push the prices lower. And I think that's true. So over a longer period of time, inflation is kind of down only. You're going to have spikes within that. And I think like we're so concerned right now about this spike, but it's like, man, like I think this too will pass, and it will go back much sooner than people are imagining. Well, sorry, much sooner than Druckenmiller's imagining, because I think people were imagining that we would go back to like a Fed pivot by the end of this year, which is not going to happen. But it's like, I think we will see a bull market by like 2024 or 2025, in my opinion. That's sort of my estimate.
Yeah,
it's not a 10-year.
I don't disagree with that. It's just sort of a question of like, how long is that bull market?
Right. Well, yeah. Okay, that's fair. I mean, is this a sideways chop? I guess that was your way of describing it, or is this like a down cycle back to the next bull?
I think what you're saying is true in the long run, but it reminds me of that John Maynard Keynes quote, like in the long run we're all dead. So there's a point where you're correct, but if that point is a decade or 2 decades, like that's pretty rough.
Forecasting out to the extreme, it gets really easy. We're all dead.
I mean, I was talking to the Discord about how rough of a shape Europe is in right now. Like Doomberg, which is one of my favorite Twitter follows, the little green doomy energy chicken on Twitter, who puts out really great and super thorough content on energy, which is like the thing to understand in the world today. So I can't recommend him highly enough. He says like energy is life, and he had an interesting way of framing it. Like he's basically said that like what European manufacturing does is it sort of takes cheap energy and it arbitrages it into tangible goods of value and then sort of sells them to the world. Without the cheap energy, there is no longer an arbitrage present, and there's no longer a reason for a lot of this industry to even exist there. Like it's like this entire thing we sort of took for granted that was basically a cheap energy arbitrage. And that's gone for the foreseeable future, right? Europe doesn't have any internal energy production. They were relying on Russia. We know the whole drill. Like, I don't know, like that's not coming back. That's going to have ripple effects throughout the world. China is not even, China's not even open yet. China, all that oil demand.
That's kind of I guess there's a huge demand coming. Like, oh man, long energy is the play.
At some point, yeah. But like, God, oil we talk about Ethereum and Bitcoin being nasty, but oil is a hell of a thing to trade.
Yeah.
Insane volatility.
The U.S. is going to replenish their reserves too. I mean, they've been just letting those reserves flow. So they're going to have to replenish those at some point.
Yeah, the administration said they were going to basically just buy oil below like 80 or something, which is kind of an odd move to just tell the market that. And then I guess it becomes a game of chicken. Like if you If you believe them, I guess you just sell puts at like 75 and print.
Yeah, right.
But if not, God help you. But yeah, I mean, I'm sure they will at some point. Do you have any other burning questions, Armand?
Yes, Saya. No, what I have is not so much thanks for the check-in, Stephen. What I have is not so much a burning question, but a kind of I want to loop it around to something from the macro to the micro, from the mind a little bit back to the heart for a second. There's so much of this that is just based purely in taking the data that we can and making sense of it. And when I look at my world, when I look around at the company I run, the people that I talk to, and the market that I see, what I see is I don't see wages around me going up for the most part. I see most people in struggle city. I see most people complaining people that never complained before, complaining about the cost of gasoline, even friends of mine here in San Diego, and literally changing their behaviors and where and when they drive in response to the price of gasoline. I never thought I would see that coming, especially in our world. I see people looking around the cost of goods, the cost of their rent, the cost of homes, and seeing that they're more unaffordable than ever, waiting for home prices to come down, but then complaining about the fact that interest rates are so high that now that they finally might have a little bit of inventory and opportunity to buy the home, they actually can't because they wouldn't be able to afford the payment. I see a lot of people confused, struggling, and not knowing what to do next. And that all concerns me. I look at the tech world and I see layoffs happening. I see, my brother, for example, if you're looking for an incredible account executive, salesperson, my brother is an absolute fucking machine closer, and he is going to have absolutely no trouble, getting a new role at another incredible company. But, working at Twilio and wakes up,
laid off 11% of their workforce.
Yeah. 11%.
Of course, they're going to start with the highest earners.
Yep.
So that's what happened.
He was crushing it. He was there for 4 or 5 years. It was a great situation, though. His stock fully vested, and he's in a great situation. But you see that 11% of that company, which was looking fantastic over the last 5 years, laying off its workforce. You look around at the big tech giants, and they're pushing people out. They're doing it in a more gentle way. You got to come back to the office, or your flexible work arrangements are no longer valid, or just like all this bullshit that you want, we're cutting back on the bouncy balls, the food, the gyms, they're cutting back on all that stuff. Startups are no longer competing with benefits. They're going to start paying people appropriately now, what they think that they are worth, not what they have to pay them in order to recruit them. But I also see unemployment going up, and people being desperate for money, but not necessarily having the right home or job to go to. I just see a lot of chaos and confusion, and I don't know what to do with that necessarily, because I think that the play is finding these edges, finding these trades, and making money in this down market that could be 2 years, could be 5, could be 10. And so the real question is, okay, we have the old famous saying of, this is where the money is made. This is where wealth is created. And my question is where and when? And I hope that we continue to talk about that in these money segments, because I don't see it yet. I do not see those edges yet.
I think what you said is super interesting, because what you said sort of anecdotally, like, really conflicts with like a lot of the jobs data I looked at. But I think there is actually like a rhyme to it, or a reason to it, a rhyme and a reason to it. I don't know. But like you mentioned, like Twilio, and like we're obviously very adjacent to like Silicon Valley and like these types of like tech. Like I don't know anybody who works on like an oil rig, right? Like
yep.
I just like, and I think that those types of companies, and when you said like the snacks and the ping pong and the arcade hoop machine and whatever other nonsense was in there, like there was this sort of bubble where there was so much cash that we just sort of inflated the value of like all these employees, And then like Facebook and Google and like the big guys sort of like gobbled them all up, and we
Well, it
just
was
totally
the only
distorted
way to recruit them as well.
the total distortment of the labor market, right? So I actually think that specific segment of the labor market, probably is deflated, because that's in like the long duration end of the bucket, right? But then simultaneously in like other areas of the economy, like, man, the workforce is looking really strong actually still. So it's like,
Yeah, but I'm looking at, and yes, it is anecdotal, but it's also it's our industry, right? It's tech, it's innovation, it's where all future value is being created and derived from. It's where most of the jobs are, in terms of like the highest paying jobs, the jobs where people are remote or working from home. Oftentimes, this is that industry. And when I look at that, I see struggle city. I see people like going. I mean, if you look at even just like the startup world, it's like, you don't want to operate right now without 24 months of capital. Like that's bare minimum. And so the layoffs that are happening, whether they're at $1 million company level or $100 million company level, that's the level of cut they have to make. 24, 36 months. That's where it's at right now. And those are the people that are being affected. And sure, those people are already better. They're more well off than say like middle class or lower middle class people. Sure, but they're still going to feel the pain, and they're what drives the market for the most part.
it's hard to explain to somebody that like, oh, well, you were reaping all these benefits of this intangible thing that inflated your value for years. So tough luck. That's not great.
So to your point on when, like as I'm thinking about it, like we lived in San Francisco for 10 years where we were like next to the innovation and all the venture and all the shit. I think there's still too much money. There's still too many dollars chasing too few great projects. That has to normalize.
It has to.
And
I think this is very good as well.
just culling
For the
earth.
economy,
Yeah.
I think this is good. For the market, I think this is good. I want to go back to the Warren Buffett ways, honestly. None of this made sense over the last 12, 13 years. It just didn't make sense. Nobody knew what was left from right. It was just we were following liquidity, as Stephen was saying. But like going back to a place where you can actually evaluate a company and bet on the people, the product, their ability to move toward profitability. Like those are important things in a business that we just haven't seen in so long. So I like that. I do just worry about the impact this has on people, because I think it's more significant than we realize. And I think, yes, cash is high. People have a higher savings rate than ever before. That I saw as well, Stephen. But I think there's a lot of people feeling the pain.
I mean,
that we're not
important
talking
to
about.
note that that's in the aggregate, right? It doesn't mean there aren't like tons of people out there who don't have cash.
Well, that's why I said we'll go from the macro to the micro.
But
The macro, it's like, sure, they're nothing but a number. But in the micro, it's like when you go down to the individual level, what people are going through, I don't think it's very rosy.
It's interesting too, though, because like the other side of what you're saying is like you and I got some late night Chick-fil-A the other night, and they had a big banner outside. Actually, it was In-N-Out.
It was In-N-Out.
Huge banner outside.
It was unbelievable as well.
Now hiring $25 an hour. So for all of these,
And they were so happy.
All of these, all of these kind of like devs or Silicon Valley people like losing their jobs now in these tech companies. There are service industry jobs paying $25 an hour all of a sudden that like can't find labor. So there's been this like kind of reshifting of like, between like tech and like labor, like people who do software, people who like work with their hands, like service versus, and I think to an extent that's good. That's like a bit of a reversal of what happened for the last few decades. But unfortunately, it is the stated goal of the Fed to sort of stamp that out, and you're starting to see a lot of blowback on the left from that, which I think is kind of interesting. But that's probably a topic for another day. I guess the alpha for people because you were mentioning like what the hell do you do? I would point out something that's like interesting out there that maybe is not at the top of people's minds because it hasn't been a thing for a while. You get like 3.5% in a money market right now. Like you can just park cash in US dollars, which are just going to the moon apparently, while all our per euro friends
I haven't looked at the money market in ages. What is that every institution?
You can buy bonds and make like 4%. So maybe it's not that bad right now. Maybe it's just like protect what you have, stay in cash, be patient, earn that yield.
Boomers love it.
We used to get out of bed for 4%. I mean, not me, but people I know, that was the thing. We just got kind of hooked on, GameStop and Tesla and crypto and
like
whatever crazy stuff. But like that is the thing out there for people if they want to reorient.
Alfalfa for me is going to be like, let's just follow the venture flows. Like when that dies, then we'll know that it's like, okay, now it can be time to turn. Like we're still just so overinflated in crypto, like the fully diluted valuations you're talking about on like $6 billion FDV ape coin. And then, like all these like zombie companies that are negative EBITDA, private valuation, just so absurd still. So
I probably should have saved this for the Alfalfa round actually, but like another thing you can do that's interesting instead of buying bonds, if you were like a somewhat more advanced investor and you want to have some negative risk in your portfolio, like you want to profit from the bleed out, like you can micro short, like you can short very small amounts of like baskets of altcoins, some of which you can borrow for basically nothing and just sell them, right? So if like 5% of your portfolio is in a basket of altcoins that you think are going to lose 75% in like a year, it's like a 3.5-4% yield. That's pretty good. That's like bonds. It's like another part of your portfolio that's getting some exposure to this element of the market. You're not going to get liquidated on that. That's like a thing. There are options out there. It's just like you can't just like close your eyes and buy Tesla anymore and just buy a house for 0% mortgage. It's just sort of over.
Indeed.
For now.
Indeed. All right. I think that's a good place to call it. Thanks, guys, for tuning into this one. Curious what you guys think about this format that we did. We're actually going to do something kind of similar in the politics segment and go through more than one sort of topic and kind of do a little political popcorn. So hit us up in the Discord. Let us know your thoughts on the format. Always evolving, always getting better, always loving this. See you guys next time. Peace.
adios.
Peace.